After enduring relentless selling throughout most of the U.S. winter months, nat gas prices appear to have finally stabilized. The front-month futures contract hit a low point of approximately $1.65 in late February before recovering to about $1.90. As a result, U.S. natural gas is currently the most affordable primary energy source globally. While a similar surge occurred in late December and early January during a cold spell across the United States, this bullish momentum was short-lived, with prices plummeting by 50% as warmer seasonal weather returned. However, there now appears to be a sufficient production response from producers, which should help establish a price floor. It seems reasonable to assume that nat gas has hit its bottom. However, this doesn't necessarily translate to a bullish outlook. Quite the opposite. Due to record high production levels at the end of 2023 and decreased demand from warmer weather during most of the winter, underground storage of natural gas has experienced weekly fluctuations exceeding seasonal norms. While withdrawals from storage have been occurring as expected during the winter season when demand peaks, these withdrawals have consistently fallen short of typical levels for the December to February period. Despite the market operating at a deficit, leading to inventory draws, the deficit has been much smaller than usual for this time of year, contributing to the recent sell-off. Consequently, nat gas storage levels are significantly higher than usual at this time. Current storage stands at approximately 500 billion cubic feet above the 5-year seasonal average. According to our basic supply and demand model, inventories are projected to end the withdrawal season at around 2.2 trillion cubic feet, or 550 billion cubic feet above the 5-year average. Weather remains a crucial factor in natural gas trends, and recent months have been largely bearish, with current models indicating continued warmth in the coming weeks. This warmth is largely attributed to El Niño, which historically brings milder winters to the U.S. Despite earlier expectations of a potentially shorter and weaker El Niño, this has not materialized. However, signs suggest El Niño may soon transition to a neutral state by April, according to prediction models and historical data. Looking ahead to the rest of 2024, a return of La Niña around July to September is anticipated. This could lead to a bullish outcome for nat gas prices due to potentially higher summer demand, driven by increased electricity consumption. Additionally, La Niña may elevate hurricane activity in the Gulf of Mexico, potentially disrupting natural gas production and transport, with impacts on both domestic and international markets. For now, the weather outlook remains bearish to neutral until these transitions occur. In the realm of commodities, the principle of higher prices counteracting higher prices, and vice versa, holds true. Fortunately, U.S. producers have stepped in to address this dynamic, with companies like Antero Resources, EQT Corporation, Chesapeake Energy, and Comstock announcing production cuts or reduced drilling activity in response to lower prices. This has led to a decrease in dry nat gas production from 105 to around 100 billion cubic feet per day, fueling a recent rally and strengthening market fundamentals. Expectations suggest production will hover around 102 billion cubic feet per day for the next 3 to 6 months, with any drop below 100 billion cubic feet per day viewed favorably by market bulls. Rig counts have been signaling this decline in production for some time now, indicating little to no production growth until at least the summer months. However, it's crucial to note that this reduction in production is largely a result of subdued demand, particularly due to the unusually warm winter experienced this season, save for a brief cold spell. While weak demand has led to inflated inventories, the expansion of U.S. LNG export capacity throughout 2024 and 2025 is anticipated to alleviate this surplus. If production remains steady at 100 billion cubic feet per day over the next 6 months, storage levels could end injection season in line with seasonal averages. However, these forecasts are contingent on various factors, including weather patterns and the response of producers to market conditions. Higher prices could prompt increased production, affecting inventory levels accordingly. While the near-term outlook for nat gas prices has shifted away from being excessively bearish, it hasn't quite turned bullish yet. It has been bearish for most of the past few months, and much of this warmer than usual winter can be attributed to El Niño. The trajectory of prices over the next 3 to 6 months hinges on whether La Niña materializes in time for the summer in the northern hemisphere, bringing potentially bullish weather patterns, as well as how producers respond to potential price increases. If these factors align positively, alongside the ongoing expansion of LNG export capacity, natural gas prices could see a substantial increase by the end of 2024. However, there are several hurdles to overcome before reaching that point. On a positive note, we have moved past the seasonally negative phase for nat gas prices, with the next few months typically showing bullish tendencies. Additionally, speculative positioning is nearing its most bearish levels in years, leaving room for speculators to be squeezed and for upward buying pressure to emerge. This factor has likely contributed to the recent uptick in prices and could serve as a significant boost if bullish fundamentals materialize throughout 2024. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.